Well, good afternoon, everyone, and thank you so much for joining us for our webinar on the new stimulus package and an update on the PPP. My name is Nancy Melberg, and I'm sure that a lot of you have probably seen me on some of our other PPP webinars. I like to sometimes call these our PPP book club. I will be joined this afternoon by my colleagues Eric Trost and Dan Glomsky. And before we get started, I just want to say, wow, what an incredible 24 or 48 hours this has been for us, and I'm sure many of you, as you have been probably paying attention to the news and to everything going on. I think we have seen a lot of emotions, and I know we certainly have been filled with some excitement, some disappointment, some uncertainty. And as we planned for this webinar, we felt pretty confident about the stimulus package that was going to be signed by the president, only to have the disappointment that the president has now said he's not going to sign it. However, we thought it was very important that we continue this webinar and we provide everyone on this webinar information on what is included in the new stimulus package, what is included in a possible new PPP, and we will make sure that we point out where some of the conflict lies or some of the things that we feel pretty confident about versus the things that maybe we're not too sure about. So I'm going to play a little bit different role in this webinar today, and I'm going to help moderate it. So with that, I would like to invite Eric and Dan to jump on, and let's get started with some of the exciting new things that we have to talk about here.
I agree, Nancy. This has been an interesting time, and certainly, we've been watching the news and reading things as they came out, and seemed like the compromise had been reached and the bill was going to be all set for the president to sign. And obviously now we get to editorialize on whether it will or will not be signed. But for the most part, I think a lot of the things we'll talk about here, some of them may be as part of that discussion, but for the most part, we believe that we'll still see these changes coming through. It might delay in time, but I think we'll see them at some point in time in the future. So we're going to spend a lot of time on this first slide.
I want to just real quick, Dan, before you go forward, if anyone has any questions as we're going through these, please type them in the chat. We'll try to address them as we're talking instead of wait till the end. I want to make sure that we hit on things as we're talking about something, and if you need more clarification, so please feel free to use the chat. So with that, Dan, let's get started.
Actually, I have my first question for you, Dan.
I can't wait.
Right. So we're about to talk about a law that's passed both the House and the Senate, right?
Yep.
And it's not sitting, it's not yet signed by President Trump, and he's indicated he won't sign it, or at least he's not, he's certainly not thrilled with the bill in its current form. So how confident are we that this becomes law?
How confident? I am, I'm in the camp that it's going to become law. I'm in the camp that I believe Trump will sign it. I believe that maybe he's holding out for it to be a Christmas Eve present. I'm not exactly sure. But I will have to say, the of contention in the president's position is he wants to put like $2,000 per person as a stimulus funds. And the Congress is all for that, and they've said, oh yeah, absolutely, we love that, right? But Trump is also saying he doesn't like some of the spending that's in the bill from the perspective of to foreign countries and that type of thing, which the Democrats would not be, or the Congress wouldn't be in favor of. So I think you have, they're not going to, he's not going to accept, oh yeah, let's just pay everybody $2,000 and keep the spending where it's at. So I think that the compromise, what compromise would be worked out would be going right back to the drawing board. I don't think the Congress or the Senate really want to see that. So my position is that the Senate leaders will eventually talk to him, and he'll agree to sign it with some caveat that, hey, more help's coming, or hey, we're going to introduce another bill or something along those lines. But I really believe that it will be signed here, I hope, within the next day. But Eric, what's your thoughts?
Maybe he'll put on his Santa suit and surprise
right.
us all.
So, yeah, I was surprised from indications that, as the bill was being negotiated, I thought that, the White House, whoever, that would represent, it indicated it would be signed. And so part of this seminar set up, and frankly, a lot of seminars that were set up right now, is that there was an understanding the president was going to sign this up until when he didn't. I'm just not so sure he's going to sign it, Dan. But there are ways for this to become a law, even if he doesn't sign it. I do believe that the information we're about to present today will eventually be law. But I want to make clear it's not yet. And I guess nothing's ever a done deal until it is a done deal. And so we sit at the eve of, having a big spending bill and a COVID relief bill and everything we're going to talk about here. That seems certain. I still believe that it will pass, but we cannot offer that 100% certainty we'd like to in light of recent events.
Yeah, I think that's a good point, Eric. I think even if this were signed into law, I mean, we would have still had an element of uncertainty with respect to the content, purely because we're starting with a bill and there's a lot of evolutions that happen once that bill works into the practice. So, so with that context, let's just jump in and then we can kind of speculate on, basically the outcome and how it affects businesses. And the first topic we have here is taxability of the PPP loan forgiveness. And so just a little bit of a background. So the initial bill, the CARES Act, introduced the PPP loan. And within that bill, it said that the forgiveness of the loan would be a non-taxable income to a business. And as a result of that, the IRS issued its own guidance saying, yes, we agree that the forgiveness would be a non-taxable income item, but there's regulations out here that we use that say that if I have expenses that I use to generate that non-exempt income, that those expenses become non-deductible. And so that was where we were kind of operating with our models and preparing for tax planning purposes, as it was going to ultimately create a tax situation, because although the income's not taxable, the deduction's not deductible, that puts us into the same spot that the loan forgiveness would generate taxable income. And so over time, there was always proposal bills saying that we're going to fix this, we're going to fix this. Well, this bill goes ahead and does that. So at this point, the bill is established to restore, I say restore, but the expense connected with the PPP deduction is now allowed and not subject to the IRS's interpretation of the regulations application to the non-taxable income. So what we end up having is the forgiveness of the income is a non-taxable income, and the deductions that you paid for the employees' rent and other expenses that were qualifying are now eligible for their normal deduction in the course of business. So yes, go ahead, Nancy.
Dan, I have a question for you regarding that I'm sure is burning in everyone's mind right now. Is what does that mean for things? Do we still have some concern about some state credits or R&D credit where we know that the wages were used? And I know there was some concern early on that if we couldn't take the deduction for those wages, how could that possibly affect any of those credits?
Yeah, so, and I really kind of welcome Eric's comments on this as well, but my perspective is, so the federal rules are the federal rules, and so then the IRS will interpret them, and I would say that if the expense is restored from that perspective, I would say that the expenses are now eligible for R&D credits at the federal level, and other credits that would be applicable to the wage income.
Like the QBI, the limit for the QBI
Correct.
or qualified business deduction.
Correct. But the state is a little bit of an uncertainty, because what happens is procedurally, the federal government issues its rules and regulations, and then the states choose to accept them or write their own versions of those particular tax treatments. Or at least I expect that Wisconsin, for example, will accept that. But that is, it's ultimately got to be determined from from the state level. So it would be an element of uncertainty. But Eric, what's your thoughts on that?
Yeah, so just kind of recap what you said, Dan. When we were doing tax planning for folks, it was how should we treat our PPP loan? Should we treat it as taxable income, assuming it's going to be forgiven or not? And originally, the way the IRS put their guidance out, we were going to have to treat the PPP loan when it was forgiven as taxable income. Now this law, should it become law, said no, that PPP, the expenses connected with that are deductible, which means that we can, in our tax planning for your year end, we don't have to treat the PPP loan forgiveness as taxable income. And so that shifted gears as soon as this law was passed by the House and then of course by the Senate right away. And we're telling everyone these are good expenses now, as well as these expenses can be used to calculate the R&D credit and other credits that are based on wages. So as long as this law passes, Dan, I agree with you. I do believe this, again, is going to become law eventually, and that the effect it's going to have on R&D credits and other credits with respect to wages, it won't have an effect on them because they're going to be just like any other wage that would be able to add to the credit.
So Eric and Dan, I also have a question, or see if you agree. Do you agree that this PPP forgiveness and not being taxable will increase the basis for clients?
Yeah, it'll increase the basis of a flow-through entities in a flow-through entity for the partners or the shareholders.
So in other words, it could free up some losses for people because it's generating income, even though they're not paying tax on that income.
Yeah, that's right. I mean, tax exempt income is an increase to basis for a shareholder or a partner. So if nothing else, the fact that this is tax exempt income and it flows through to that shareholder or partner, it does increase their basis and would be then available for losses or distributions as the case may be.
So Merry Christmas, everyone.
Yeah.
Not yet.
Well,
Maybe it'll be Happy New Year's.
yeah.
But I think that's a great point. And I think so we always kind of look and say, wow, this is really too good to be true. And it certainly does look that way from the individual businesses that were eligible to receive it, receive the funds, were forgiven, and they still have that cash in theory sitting in their bank account. And then now for that cash, if it goes to the shareholders or the members, right, it comes out to them tax-free because they have that increase in basis, and they can take that distribution or draw against that basis. So, for business of that nature, this is truly a win-win and a great opportunity, to get access to that money. For the businesses that were struggling and don't have the money sitting in their checking account anymore, right? It's probably the appropriate answer, because if you took all the funds, paid for employees, and now don't have that cash available because you paid it to the employees, now to put a tax burden on you for that particular cash, where's it coming from, right? So I think it comes to the right answer, but there's definitely going to be organizations that are in good shape as a result of giving them the tax-free treatment. All right, so I'm going to move on to the second point because I think it also creates quite a bit of dialogue and question. The second is a second round of PPP loan application funds. So some people call it PPP2, but it's really another opportunity for businesses to qualify for an additional round of PPP funds. And it's really criteria based on the same information that was used for the first application, which was 2.5 times your monthly payroll costs as the value of the loan proceeds that you could apply for. But the additional criteria here is you have to have greater than 25% or greater reduction in a 2020 quarter compared to 2019's quarter.
So Dan, on that point real quick, we have a great question that came in that actually I hadn't even thought about, is when calculating the 25% decrease, will clients need to include the PPP loan proceeds that they received in calculating that reduction?
Yeah, I would say that I think we're looking for a reduction in revenue, and I would say that the PPP funds were not revenue per se. I would consider it more other income of that nature. So I think it's purely looking at your revenue numbers. So if you had 100,000 of revenue in 2020 and you had, 500,000 in 2019 for that quarter, it's based on that 25% reduction is going to be based on that. Now, again, we're dealing with a bill. We're reading the bill and making an interpretation. So they are subject to change from that perspective. It's eligible for employers that have less than 300 or less employees. And the maximum amount of loan that you can qualify for is 2 million. So you can't ask for more than 2 million of loan proceeds. And within that, there's a requirement in the bill that within 10 days, the SBA has to roll this out. So we would expect businesses to be eligible to apply for it within 10 days. I know some banks have already notified customers that it's up and going on their portal. I haven't tested whether that's actually true or not. But I think the first criteria is to making sure that you meet that 25% reduction threshold, right? And then we start doing the math. And we've gone back and forth as far as, how quickly is this program going to use up the funds, if at all? And I think Eric has some commentary on that.
Well, Dan, I guess the first question is, how can a bank have a portal up and running for a PPP loan application that doesn't yet exist and isn't law?
I agree.
Well, everything's possible. We got to, kind of work with the system here, but, yeah, that's what I've been told. So
I do think this is an indication that for anyone who had struggles in the first round where the banks weren't ready, I think this is just an indication that the banks are going to be much more timely in having their portals open in this round. I think a lot of them have learned what's needed, what the SBA is looking for, and I don't think we'll see the delays that we saw the first time.
Yeah, I agree with you, Nancy. I think there was a big learning curve for the banks the last time around. There's a completely new kind of loan. But I think in that learning curve, they probably gathered enough that they can roll us out pretty quickly for the second round. And that goes for the SBA too. That 10 days is 10 days for the SBA to have the application ready, have the program ready. And so it's 10 days from whenever this law passes. So that hasn't started yet, but expect a quick turnaround if and when this law does pass, because I think the SBA already has their application forms from the last go round. They just have to change the criteria on this. Dan, to your point, oh, sorry, Nancy.
No, go ahead.
Yeah, we'll talk to Dan's point about how quick this money is going to run out. So the first go round on the PPP, there were a lot of applications. And in fact, the first allocation of funds did run out, and there was a second allocation of funds. And in fact, there was up to 600 billion or so available of PPP, which eventually didn't even get used. So the first go around, there was an allocation. It got used up very quickly. And then the second allocation didn't get used up. This allocation right now is somewhere around 280 billion. And the companies that are going to qualify for this and the loan cap at 2 million, I think is going to make it that this go round is not all going to get used up, or at least get used up much slower than the first go around the first time. So I don't believe you have to be first in line to get this money. You'll have time to do your calculations, make sure that you qualify under the new criteria, discuss with your advisors, and then submit the application.
So we are getting a lot of people asking very specific questions. And I do just want to say that we don't have all the details yet. Just like in the first round of PPP, details came out, as the process was moving forward. So since this hasn't been signed and we don't have all the details of that, I don't think we're prepared to answer some of these very specific questions yet. But we will continue to inform people. We will send out e-alerts and more than likely have another webinar as we get more details. So I apologize if we're not answering every question that comes through, but I just don't think we have those answers yet.
Yeah, we do have some, Nancy, so I don't mean to contradict you, but there's someone
Yeah.
asking, will this be forgivable? The answer is yes. This is still a PPP loan that would be forgivable.
Yeah, I think some of them are, what is the time period that we're going to be used to look at the 2.5 times monthly payroll costs?
Yep.
Not sure we have the details of that yet.
Yeah, the details are in the bill, but I haven't read that part of it yet. So what we do plan to do, though, is have another seminar. I think when this is more certain to be law, which we thought was this time, but maybe it'll be next time, and then give the details on that application. So we'll hold a seminar and talk about specifically how to apply for this second round of PPP. We're thinking sometime it's going to be in January, second, third week of January, that we'll be able to do that. Again, assuming that by some way, shape, or form, this becomes law.
Right, but if we talk conceptually, right? So, really the intent of us getting this webinar information out to everybody is so that we can start strategizing on what our options might be and conceptually whether we qualify or not. So I think our first, agenda items would be to let's see whether we have a drop of 25% or greater in any quarter. And how do we define that might not be clear at this point, right? Is it cash basis, is it accrual basis, and that type of thing. So there's some questions with respect to that, but let's look at it both ways and see if we have an opportunity. And if we have an opportunity under one versus the other, well, maybe we still see what the ultimate bill does as far as, or the instructions and that type of thing. So I guess our encouragement would be let's start planning, let's start thinking this through. Same thing with the 2.5, let's use 2019's payroll. Let's use the same numbers we used for the first application if we apply for one, right? And then maybe there's going to be a revision to it to some degree, but at least gets us ready. And I think Eric's point as far as the timing goes, do we need to be first in line? If we needed to be first in line, I would say yes. Then we got to rush and we got to make some assumptions and get ready to go here. But let's rely on what Eric says here from the perspective of, we have time here, right? Because Eric's not, necessarily his track record on some of these predictions, is good, but it's not perfect. I still like to go through the process and try to get it going from there. So that's really the intent here. And I think this should be enough information to at least get us started. But within 10 days, we'll know definitely a lot more.
So Eric or Dan, I do have a question for you. Do you guys think that the $2 million limit is going to be combined between the two loans, or they'll look at them independently?
It's independent. This is a second draw. So even if you maxed out on the first loan, and let's say it was 1.5 million was what your calculation allowed you to get on the first loan, and now this second loan opportunity does come up and the calculation happens to be the same, and I don't know exactly what the calculation will be there, but let's say it's the same and it's another 1.5 million. That 2 million isn't a cap on those combined. It's a new 1.5 million for you. So
that's great.
So specifically in this law, this is a second draw and a second go around, and it's not based on what you got on the first go around. I'm not even sure you had to get it in the first go around to actually qualify for the second go around. So even though they call it a second draw, it doesn't necessarily mean you had to get it the first time around to get it this second time around.
Right. That's great news. In the bill, you can go for either. If you hadn't applied for it in the past but now qualify, you're eligible to apply again. The next topic kind of leads into, I think, a consequence of this second loan is the SBA's, according to the bill, is required to issue its procedures and its criteria for reporting on on how they're going to audit these for PPP loans. And they have 45 days to put something together and get it published from at least to the committee. And so we see that companies that are over $2 million are your targets for these audits. And so then, the one thing that comes to mind as a result of this second tranche of PPP money is if I had a $1.5 million loan for the first go around, and now I apply for another 1.5, right? I'm now at 3 million. And I think now I'm now back in the audit target versus before. So I think that's something we want to keep in mind, maybe one of the consequences of applying for a second tranche of money. But again, if you're in position to qualify for it and have that financial hardship, I think that that's really your case. And it's not the fact that, oh, I'm now potentially auditable. Well, you might have to deal with that, but I wouldn't necessarily be scared of that audit, and we'll know within 45 days on what that looks like.
And again, it's 45 days when the loan passes, Dan.
Yep.
So we can't start the clock on that yet, but what we're looking for here, I think, is much more important than just, will I be audited or not? It's, I think these rules have to be provided by the SBA so that any given company knows what the SBA's ground rules are on auditing loans, and really their audits can go for any loan over 150,000 under this rule. They've only said that they're going to audit for loans over 2 million. That doesn't mean they can't audit loans under 2 million. So these rules, though, I think tie the SBA to some policy and procedure that now can rein in what I think would otherwise be, we'll call them rogue agents, that a rogue agent could decide that under their audit that somehow a company didn't meet all the qualifications from a judgment standpoint, not from a mechanical or calculation standpoint, but just from a judgment standpoint. You didn't need the money, therefore you have to pay it back. With those kind of judgment calls, you really need some guidelines for the SBA personnel that are doing these audits, or the results are going to be all over the board. And so I think the good news that's coming out of this law, should it pass, is with these policies and procedures, you give the people that took the loans out some assurance of what actually are the rules that are going to be used to look at, whether my loan was needed or not, and if I should have to pay it back or not. And it's not going to be subject just to some government employee.
So that is one of the questions. One of the questions people are wondering, is this 25% reduction going to really meet the necessity need? And I agree with you, Eric. I think that's probably why that measure is put in place, so it doesn't become as subjective.
Yeah. So the first go round of loans, the question asked was to the effect of current economic conditions necessitate the loan. Do current economic conditions necessitate the loan? There was no numerical test for that. This second round, this second draw of PPP, they're putting in a numerical test. You have to show a 25% decrease in sales quarter over quarter. Now, let's say your sales went up 250%, but you had one quarter that was really bad in 2020 versus 2019. Do you get the loan? Well, mechanically, you would, because that's all they're looking at is a 25% reduction from any given quarter in 2020 versus that same given quarter in 2019.
Yeah, so if you have a loan that's over $2 million, there's now that necessity questionnaire that needs to be completed or could be requested, and in all likelihood will be requested by the SBA. And, so there's a context of providing that questionnaire response, and then the SBA could come back with more questions and document requests. So what I think this starts to do, one thing this procedure does is it lays out where are they going with this and why are they asking the particular questions. And based on the procedures, my answers are maybe going to put me in question, or maybe we're fine, right? And I think that helps us respond appropriately to the request. And then I think levels the playing field as far as who's going to interpret and how are they going to make the determination. Because I believe the first criteria is very subjective. There was, like Eric said, there was no numerical assessment as far as whether I needed the money or I didn't need the money. It was, hey, is there an economic uncertainty that required the need for this loan? So this will be interesting, but one thing we want to keep our heads on. And then also, if you are looking to, if you have a loan over $2 million and you haven't made your loan forgiveness request, you might want to hold off on making that loan forgiveness request. We do have more time to do that. You might want to wait until we actually get these procedures out there to kind of be able to respond to that necessity questionnaire. And then what is the SBA really going to look at? Okay. All right, so then the next topic is $150,000 loan forgiveness simplification form. So from this perspective, it's kind of mainstreaming it. It's really kind of a simplification. And Nancy, I think you have some background and some understanding of this section.
Nancy, you're on mute. Sure, you're saying great things right now, but
I had very, very insightful information. Thank you for that. Anyway, as I think a lot of you probably are aware that currently there were 3 applications out there that you could apply for forgiveness under the PPP. There was the 3508, which was the standard application, which included a Schedule A and a lot of documentation, calculation of your FTEs. And then they came out with a form 3508EZ, which was about a 1-page form that required a lot of certifications. You were certifying that you didn't reduce anyone's pay, hourly or gross wage. You didn't reduce your FTE count. And then if you certified this, it was a little bit easier application, but you still had to go through the calculations to make sure that that was the case. You just didn't have to apply all of the Schedule A's and the additional information. And then they came out with much later, they came out with what was called a 3508S, which was a very simplified loan application for anyone whose loan was $50,000 or under. And that was really just a check the box certification saying that I basically used the funds for the qualified expenses. I didn't reduce anyone, and this is my loan amount, and I'm applying for forgiveness. Very, very simplified form for those 50,000. I know that early on, we had a lot of hope that these loans would be automatically forgiven and there would be no application needed. However, that was their answer to that, was just the simplified form. I do believe, and again, this is something we'll get more clarification on, but I do believe that this $150,000 simplified form will follow the 3508S, which is currently at 50. So my guess is they're just going to increase the limit and allow many people whose loans was 150 or under to use this 3508S or something very similar, just to check the box certification and call it a day. Yeah, so that's where I think we're at with that.
Yeah, and I think the takeaway from this perspective is if I haven't applied for my loan forgiveness and I'm at 100,000 of loan forgiveness application, maybe I hold off until this bill is signed and they're ready to receive it. From an administrative perspective, less documentation I have to pull together should make the process go a lot smoother. So it might save you some time. Again, the urgency to file these forgiveness applications, if you're going to get 100% forgiven, is really kind of more, I just want to put it behind me. Well, if there's a lot of work in the front side where we, you're spending resources putting things together and so forth, you might be able to save some of that by waiting for this 150 simplified form to come out and be usable. So we'll see how that goes.
Agreed. And then I think in addition to that, so on the existing application, there was a line for anyone who got the EIDL, which was the Economic Injury Disaster Loan. There was a grant that was attached to that loan, which was up to $1,000 per employee, or $1,000 per employee up to $10,000, where people automatically got that. What they called was an advance or a grant on that EIDL. That previously was reducing the forgiveness amount that people got on their PPP. So if they had a $200,000 PPP loan and a $10,000 grant from this, their PPP forgiveness was only going to be $190,000, and that was built into the application. With this new stimulus bill, they have changed that and reversed that, and so they are no longer reducing the PPP forgiveness by this grant. So I do expect that there will be some modifications to the applications that take this off of the application. What I'm unclear about at this point is I'm unclear for all of those people who have already applied for forgiveness, have already received forgiveness on their $190,000, and they have this $10,000 loan sitting on the books. I'm unsure if the SBA will automatically come back and issue something that says, the loan is paid off, you no longer owe this. I've read some things that there could be an amended return or an amended forgiveness application that people need to fill out to get this $10,000. I think that is something that we're going to have to keep our eye on. I know we have filled out a lot of applications for a lot of people, so we will make sure once we have that final answer that we are trying to connect with people if there's any action needed.
And I think that's all great stuff, and we'll keep our eyes on that. So let's move off of the PPP loan activity for a little bit, and let's talk about a couple other things that are in the bill that might be of interest to some businesses and some individuals. The first one is employee retention credit, and the reality was in the CARES Act, they introduced this employee retention credit. It was eligible for companies that had a greater than 50% reduction in activity or revenue. That threshold has been changed to a 20% or greater, so it would make more people eligible. The credit is now on a limited on a quarterly basis versus an accumulative basis, so it might allow for even more credit from that perspective. They also increased the level of employees that a company can have in order to be eligible. Previously, it was 100 employees. Now it's open to companies 500 or less in employee count. And the credit at this point is still eligible by completing the 941, but there also is a credit form 7200 that can be used to claim the credit for prior quarters based on this law change. Again, so assuming everything goes through, more details will come out on this retention credit. And if you were eligible during 2020 for these reduction periods, there would be a credit opportunity to go back, a form to recover that. And I believe that's form 7200. So just kind of keep your eyes on that, whether that's something that might be applicable to your particular business.
So I do think for anybody using a payroll service, you want to make sure that you keep an eye on this. I don't know if the payroll services are automatically going to be calculating this credit. I highly doubt it. So I do think that for anybody using a payroll service, just be aware of this, understand what the criteria is for it. And if you do feel you're entitled to it, make sure that you reach out to your payroll provider so they are properly reporting that on the 941 return or filling out this separate form that Dan talked about.
So another point to bring up on this is, this employee retention credit was part of the CARES Act, passed back in March. But the restrictions to get the credit were such that it was going to be not applicable for a lot of companies. This latest law change, should this law be passed, really expands the ability of companies to take this credit. And so what was once well, that's not going to apply to me kind of situation could have turned into, wait a minute, that does apply to me, did apply to me, and I should have gotten the credit. So if there was a decrease in sales in your company, and you're near this 20% now from quarter to quarter, you want to take a look at this because there might be a credit available that almost certainly the payroll company is not going to tell you about or calculate for you because it's based on your sales. And the payroll company doesn't keep that information. So it's based on a decrease in sales. You're going to have to figure, that you'll take responsibility, take a look at it, and get this information then to your payroll company so that you can get this credit on your 941. So it's going to be a lot more common now than what the law was when it originally passed back in March of 2020.
And I think somebody had asked about the credit if it's not permitted with the PPP. I don't think that that's accurate if I'm reading that question, that you can't get both. I think you can get both. And obviously with the PPP, you have 24 weeks to spend the money. So even if you had a reduction, this retention credit, I don't know that that would have an impact on anyone's forgiveness in the PPP.
Right. And by the way, there is something in the slide that says no fewer than 500 employees, no more than 500 employees. By fewer, we went more. So it's for employers with 500 employees.
Or less employees,
Yeah.
500 or less, correct.
Right. A little tricky on the English language there.
Yeah, we're trying. So let's move on to the some of the other things. So here's one of the juicy topics that's in President Trump's agenda is the $600 per person, $600 per dependent, and dependents would be under the age of 17. And then there's a phase-out limitation, 75,000 for single taxpayers and 150 for married. And if you're over those threshold, the credit gets reduced 5% for every dollar over these limits. So, so that's the current, that's what the bill reads right now. Trump's in his position is that, well, let's get $1,000 per person, or is it $1,000 per household? There's it's $2,000 that he's throwing out there, right? So we're not exactly sure what that would also ultimately translate to, but we know that this is what's in the bill currently and that both the Congress and the Senate have approved. Additionally, we have unemployment benefits that have been added to this bill to add $300 per week for 11 weeks for anybody on unemployment. It was in the prior CARES Act, it was $600 per week. And so they have some relief here, but it's not at the same level that it was on prior bills.
So I would like to just make a quick comment about this, because I think previously when they had increased the unemployment benefits, we had a lot of employers who were saying that employees did not want to come back to work when they tried to call them back. Specifically, let's say they got the PPP funds and they wanted to bring everyone back on, that employees did not want to come back to work because they were receiving an additional $300 or $600, $900, whatever that amount was back then in unemployment. I do want to just point out to people that if you do try to bring an employee back and they decline coming back, you do not have to pay them unemployment. That is important that when you get the notice from the unemployment, that you answer that if you did have work for them, you answer yes. I did recently read something that if anyone attests on the PPP application for the FTE forgiveness, that they had a reduction in FTEs because they tried to bring employees back and they declined, that they are going to somehow, and I don't know if they would actually do this, but they could look at unemployment reports. And if you certified that, but then you also paid someone on unemployment, that there's a conflict there. So just keep that in mind. If you have people that are saying, no, I don't want to come back because I want the unemployment, that if you want them to come back, then you do not have to sign that unemployment claim for them.
Okay, and then, so let's go to some other items. This bill was over 5,500 pages long.
Dan, I want to go back one slide. You don't even have to take the slide back because it's actually 2 slides ago. There was a participant who brought up this employee retention credit. Is it now up to 7,000 per employee, not 5,000? It is 7,000, not 5,000. It's actually 70% of 10,000 of wages. So it's up to 7,000 per employee, not 5,000. That was one of the changes within this potential law.
I believe previously, you're right, Eric, because I believe previously it was 50% of 10,000.
It was. So some of our participants are helping us out here. We'll call this a beta test. All right, Dan, back to you.
All right, perfect. So this bill also includes a number of extenders, and some of which clients take advantage of. Some of them are very specific to the point where it doesn't impact the general population of clients, but we will have ones. Normally, we have a client or two taking some of these credits. So the primary one is the work opportunity credit. And that one's a very resourceful credit and has been extended to 2025. And I think this is a very well utilized credit. So I think from that perspective, you'll see a lot of benefits. Something that if your business hasn't been taken advantage of, something that we should evaluate whether you have eligible employees that would produce that credit for you, but we would have until 2025 to now do that. They extended the discharge of personal residents, qualified principal residents. So if you were to go into bankruptcy, your house was foreclosed on, and as a result of that, you know, if your loan was $300,000 and the fair market value of your home was $400,000, in theory there was $100,000 of gain there, and or if your basis was anyway, if you had a gain on the sale or disposal of your house under debt forgiveness, that gain would be excluded from taxation. There's the empowerment zone tax credits incentives, and this is again for distressed areas published by the government as far as empowerment zones. Certain credits exist that are for people within that or businesses within those zones. That has now been extended to 2025. We have the employer credit for paid family leave and medical leave. It had now, that was set to expire, but that now is extended to 2025. And the ability for an employer to make payments on student loans has also been extended to, in essence, through 2025 as well. But this is something that, you know, businesses as they attract employees and talents coming out of school might be something that you consider evaluating and using, but at this point would be there until 2025. So give you some time to set up the policy and start using it. Number of energy credits, I want to say there's 15 or more different energy credits, from solar to biofuels and all those types of credits. So if you're believe you have energy conservation going on in your business, there might be an opportunity for a credit that we may want to seek. Healthcare credit was extended through 2021, so one more year for that. And then there's a variety of other credits that were extended as well. So this isn't meant to be an all-inclusive list. It's more so to give you some ones that we see probably more common than not. All right. Other key things is meals and entertainment for 2021. So this isn't a retro bill. So it would say that meals and entertainment or meals used or paid in 2021 would now be deductible, but it only covers 2021 and 2022 activities. So if you in the past that would be subject to a 50% limitation, now is 100%, trying to put some infusion into the restaurant businesses and that type of thing. So it's for basically food services coming into your business, not an existing business that has a food service inside of it. There's a minimum.
I think it's important to point out on that meals and entertainment. This is a pretty big deal because meals and entertainment has had a limited deductibility forever, and so now this is saying 100% of meals are deductible. It's gotten some bad press because they call it the 3 martini lunch deduction. But really what's come back, if this bill passes, is to, you know, try to generate some more business for the restaurant industry, which certainly would have been behind getting this into the bill.
So there's a minimum low income housing tax credit rate, I guess, criteria or expansion. So at this point, the application for the tax credit cannot be less than 4% for buildings put in service after December 31st, 2020. So again, something that should help that industry continue to procure credits and make developments in that area. Modification, here's where we have the employee retention credit again. 70% of wages, up to 10% limit, 20% reduction in the quarter compared to 2019. So kind of again, importance level, trying to hit that one more time. And then disaster relief, there's tons of activities with respect to disaster relief. I mean, there's beer and wine spirits credits. There's the eligibility for entertainment venues and these types of things. There's a lot in this bill that want to try to prop up some of the sectors of our economy that have been hardest hit by the fact of, everybody being, contained and restricted to, limited capacity venues. So there's a lot more that will come from that perspective.
So Dan, back on your extensions there, we had a couple questions come through. Did this bill extend the CARES Act provisions regarding the Family Medical, or actually not the CARES Act, but the Family First Coronavirus Response Act provisions that required employers to pay employees if they were out sick with COVID, if they were employers of a certain size, and then had a corresponding tax credit that would be taken on the employer's quarterly tax forms to offset those wages. That expired, or is set to expire, on December 31st this year. This bill, if passed, does extend that through March 31st, so through the first quarter of 2021, that this would be extended. So as of the 31st, it expires. If this bill is not passed, that provision within the Families First Coronavirus Act expires, meaning that employers do not have to pay employees for having COVID or taking care of those within their family that do have COVID. And then that credit goes away as well. This bill would extend it through March 31st if this bill is passed.
Yeah, and I think, remember the context of that is, I think it was 10 days of pay that that you had to carry through on. So I think that criteria all remains, but Eric's right. I mean, that the bill would extend that, into March.
So we do have a lot of questions that have come through the panel, but I think a lot of them we have already addressed or have brought up, and I'm just going to go over a couple of more. One question from someone coming in is, do you think that a large distribution to shareholders will trigger an audit? And I do want to point out that if your loan was over 2 million and you received the 3509, which was the questionnaire for anyone who had those larger PPP loans, that there was a specific question on there that asked if there were any distributions made to the shareholders in the covered period. Although we don't know 100%, because as we indicated earlier, we don't know the guidelines of these audits. Could that have possibly been a red flag question for them to even determine who is going to get pulled for audit? We don't know. I certainly don't think that question alone will be an automatic, then you have to pay the money back. But I do want to say that there was a question that did address that on the 3509. I think if your loan was under 2 million, unless you were randomly picked for an audit, I don't know that this would ever come into play.
Right. I mean, that's part of what we don't know right now is how are these 2 million and up loans going to be audited, and how do these questions come into play in that audit? I do believe this questionnaire certainly could be used to screen the borrowers for an audit. And if there is a distribution, then the circumstance of that distribution will, without question, be asked about. So if you're under audit and they say, well, how did you do this distribution? What was it for? Okay, it was for taxes. That's one thing. It wasn't for taxes. Well, how did you feel the ability to distribute if you were in economic uncertain times? Those are the kind of questions that could be asked surrounding a distribution.
And I think you have to, I think in some respects, you have to be patient in taking that money out. Because once you take that money out, you kind of lose your flexibility of arguing a position, right? So you can't say, oh, we took this money out and then later on argue, well, there was uncertainty going on into the future and stuff like that. It really changes your arguments that you can present in defending why you needed to take out the loan and so forth. So I guess I encourage, when I have the discussion with the clients, I'm not eager to encourage them pulling it out. I kind of want them to leave it in if they don't need the cash personally, right, to survive and so forth. Let's just leave it in the business for a little bit longer. Let's, get to some level of understanding of exactly what's going to be asked of us, how are we going to respond. And, if there is a chance that we're going to have to pay it back, I'd rather have it sitting in the company ready to pay it back than not, right? I suppose the flip side of that is if the cash isn't in the business, would the SBA then say, fine, you don't have the cash in the business to pay it back anyway, we're not going to do that. But I would say that that's probably not going to be a criteria or a conclusion if the SBA concludes that you need to repay the loan.
Yeah, I think that would be hopeful to
Yeah.
say that if the cash is not there, then that's okay. We're not going to have you pay it back.
Right.
We do have a question here about the deferred employer Social Security piece, whether that will be extended beyond 12/31/20. So that was the deferral of just the employer Social Security match.
Right. I haven't seen that yet in this bill. I don't think it's in there. What is in there is something different than that. In August, Trump actually had a executive order that said employees can defer their share of Social Security taxes, and then how the employees were going to make that up or pay it back in was going to be after the first of the year. Well, that deferral now, if employees elect to do it, is going to be through 2021 as well. So employees don't have to pay their share of Social Security. Now, a lot of employers did not offer this option. And in fact, I'm not aware of any that did, because if at some point that employee quits and the employers offer this and the employees take advantage of it and don't pay in their Social Security taxes and that employee quits, the question is, well, how does that money now get back into the IRS, because it's still owed the IRS? And the employer either has to get it from an employee who quit and they don't have much leverage over anymore, or the employer picks up the tab and has to pay it in. And so that is the reason I don't think I've seen a lot of employers offer this option to their employees. But if they did, this extension, if this bill passes, extends out the ability of an employee to not pay Social Security taxes through 2021. That's different than the employer piece, which is the employer could withhold or not pay to the IRS the employer portion of Social Security and then pay it in at the end of 21 and at the end of 22. That expires 12/31/20, and I don't think that's still out there.
Yeah, I have not seen anything on that either. The other question that we have for some people or from someone is questioning the quarterly when we're doing the 25% reduction in revenue and when we're comparing quarter 2020 to a quarter to 2019. They're wondering if it's based on a calendar quarter, or I suppose if it's a fiscal year client, it could be a different 3 months. I assume that they can't randomly pick any 3 months that they want. So it would either have to follow the company's quarters or a calendar year quarter. Have you seen anything like that in this actual bill that define what a quarter is?
I have not. I mean, I would think it'd just be based on like the payroll calendar quarters, which means everyone has the same quarters. I don't know that that's for sure or not. So Nancy, you say you couldn't pick any 3 months and say, well, this is my new quarter. That's probably true. I think it's going to be either calendar or based on your fiscal year, what your quarters are for your fiscal year.
So we are pretty much running out of time here. We're at 12:58 and we want to be respectful of everyone's time. So I want to just wrap up with saying thank you to everyone who has been on this webinar. We definitely appreciate the attendance. We enjoy sharing the information that we have with anyone. If you have any additional questions, feel free to reach out to any of us. Hopefully you have some contact here at SBA. Otherwise, here is some information too. We also have recorded this webinar. So if you have anyone who would like to get the recording, please let us know. And as Eric and Dan indicated, we will probably be following up in January with another one. So stay tuned. And as information is available, we will also send out e-alerts. So if we get any additional information that we want to push out to everyone, we will send out an e-alert. So we encourage everyone to go to our website and sign up to get those e-alerts. And with that, with 1 minute to spare, I think we're going to wrap it up. And thank you, Dan and Eric, for all of your insight. I hope that everyone found this webinar informational.
All right, thank you, Nancy.
Bye.
Thanks. Bye.